Jason, it's great to have you this morning. We just got that JOLTS number, lightest since September. We know what happened with ISM prices paid yesterday. Gas prices down, fastest decline in 10 years. But you still think the Fed's got more to do?
I think it does. I think the Fed has to be, of all those numbers, the Fed probably is most encouraged by the JOLTS data because that's the goal, really. They call it the beverage curve. The whole idea really is to try to get job openings down without really affecting jobs. So, and the ECI numbers and some of the other economic numbers the Fed watches are probably going in the other direction. So that's very positive news. But listen, Carl, I mean, let's be frank. Inflation's 9, CPI is 9, and the Fed funds rate is just over 2%. So there is a long way to go. And historically, the Fed hasn't stopped tightening until the Fed funds rate was above the CPI. And of course, these two things will converge over time. I just think they have a ways to go. And we have to remember the Fed, even though they've done a lot in terms of magnitude, they just started tightening in March, and they also really have just started a balance sheet decline too. So these are just things I think for investors to keep in mind.
Mike, you mentioned the flight to safety trade in treasuries right now. B of A points out in a note this morning how despite last week's data showing 2 consecutive quarters of negative GDP, their clients were actually net buyers of cyclical stocks.
Yes.
More so than defensive. So I'm trying to kind of understand market sentiment right now because on the equity side, it seems like people aren't necessarily pricing in a recession, whereas on the bond side, people are bracing for one.
The way I would view it perhaps is a time sequence mismatch, which is that the equity market has really punished cyclical stocks going into this phase. So you've gotten this situation where defensives have led. If you want to make the case that things have gotten overdone on the downside, you've priced in a higher probability of recession. I'm not saying we've priced in the true implications of an outright recession, multiple quarters of decline and earnings going down a lot, but maybe you've priced in the growth scare. And so that's why I wouldn't necessarily say it's a conflict. It's much more about where have we gone from 22 times earnings down to 17. Maybe that's fair-ish value. If you take away the mega cap growth stocks, stuff looks even cheaper. Smaller stocks look even cheaper. Maybe that means value. That often means cyclical. So that's why it's a nuanced story as opposed to an argument between stock and bond investors.
Jason, I'm curious what your risk appetite looks like right now. As Mike was mentioning, the whole value investing trade, maybe what does that look like in this current environment? David Einhorn of Greenlight writing in a client letter yesterday to investors that, he believes that this is not actually the best time to be a value investor and that there's just essentially been the value investing trade was oversold going into this. And now, people are kind of just coming back to it because there was nothing left to sell. So I'm just kind of curious what your risk appetite looks like amid all of these confounding factors.
Leslie, I have to say, it's not. My risk appetite isn't particularly large at this point. I do think there's been a very meaningful change in the change from QE to QT. It's probably the most significant monetary policy change since Volcker started targeting reserves as opposed to interest rates in the late 70s. And I think we're just starting to figure out how that affects especially more marginal businesses. And before we chatted, before we got on together, we were talking about how Uber is now focusing on free cash flow. And I think that is a very meaningful change. But it also means that there's going to be some change in company behavior. And I'm not sure we can count on the types of gains from the markets that we had in the past. This is a brand new ballgame in which capital, both debt and equity, is going to be rationed. I like some of the value sectors quite a bit, like energy, and I like basic materials. I think there are structural reasons for that. They obviously would be hurt in a recession, but I think there are structural reasons in terms of policy and in terms of politics, geopolitics, that is going to keep a bid in there. We also like healthcare and utilities as a little bit of a counterweight to those very cyclical sectors like energy and basic materials.